and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here. We do have a little bit longer Options Guide TV set up for you today, mainly because there's so much that's going on in the markets. We have a lot of earnings from the Magnificent Seven companies. We talked about a couple of them on Monday's show. We're going to look at those trades. They didn't turn out too well. They've actually kind of driven the markets a little bit lower at this point in time. And then at the end of the week on Thursday, we have, two of the behemoths. We have Apple and we have Amazon that are announcing earnings. And this is all happening while we're having an AI conference, or whatever you want to call, going on with Congress right now, a bunch of the CEOs. And we have a Fed meeting in a few hours at 2 o'clock Eastern time today. The Fed's going to meet and announce what their plans are for the Fed for the Fed funds rate and what they're going to look at going forward. Right now, it's highly anticipated that there will be no change in the Fed funds rate after this meeting, but March is everybody's focusing on March. Everybody's talking about March. The Fed fund futures in March have been all over the place as far as the probability of a rate cut. It's been as high as 70 at one point in time, 70% chance of a rate cut, dropped precipitously all the way down to about a 40% chance of a rate cut. And now we bounce back up after PMI numbers that we got from Chicago today. And the markets did move on, at least the bonds did. We saw the 10-year yield drop a little bit after the announcement, but we now see the Fed fund futures anticipating at a 60% with a 60% chance that there will be a rate cut in March again. So it's all over the place. And that type of volatility in it also just it doesn't bode well for the futures and the probability of getting everything right. Usually a little bit closer to the date, within a couple of weeks out, it's a little bit more accurate, but it's still fun to look at. 60% chance of a rate cut. I mean, that if we did get a rate cut in March, obviously that would, well, I don't know if it's obvious, but in general, you would assume that that's going to help the marketplace overall. So big meeting in March. After this one, let's just get this one behind us and look at some more data. And then we will come up and see if we can get the Fed to start lowering rates. Now, with that all said, my view on it is I wouldn't mind if they just kept it where it was at. I think the markets, one of the biggest things is this is really the normal. The fact that we used to have interest rates at 0% or less than 1% for years and years and years really wasn't healthy for the marketplace, and set unrealistic expectations. This is in the more normal range. I don't mind that they stay where they're at for a longer period of time, but a rate cut in general will usually help the markets. So let's see, bring it on. Here comes March and the Fed fund meeting, and it should be definitely interesting. There's going to be a lot of opinions that are going to be tossed around heading into that meeting. So we decided this week, and I guess we'll start there, looking at an S&P 500 index trade. So we've been doing speculative trades around earnings, and mentioned this a lot of times on Options Guide TV, in that we're looking at earnings and speculating on these trades, looking at strategies that we would do around these big behemoth stocks that are announcing earnings. Today, we're going to look at two different ones. We're going to look at one in Amazon. We're going to look in one on Apple. We looked at three trades on Monday because we had three very big stocks announcing. We had Alphabet, i.e. Google. We also had AMD, which, with the AI and the chip space was a pretty big one. And then Microsoft came in and announced. All of them are drifting south since their earnings announcement. And on our speculative trades, we looked at long call spreads, which means we were bullish on the marketplace. We still have some time left. They announced on Tuesday go all the way to Friday, so anything can happen. They did not move as much as expected. They did go to the downside, but they haven't. Maybe Google came close, but right now we're seeing Google down about 7%. We're seeing Microsoft only down 1%, and we have AMD down 4%. And AMD is the most volatile of all three of the stocks on a historical basis and also on the implied volatility basis going into their earnings announcement. So around these mega cap tech earnings, I decided to just do what we've been doing. In the S&P 500 index, we've been doing a lot of 1 week trades, and that's more of a staple of the portfolio if you wanted to take that approach, depending on how you feel about the markets, obviously. We looked at a skip strike butterfly in the SPX, and that trade's working out fine. The market is gone down. We were able to do that skip strike butterfly for a net credit of 80 cents to the account. So I'm going to start by checking on that trade, and that will expire this Friday. And by the way, we're getting into February. So Friday, February 2nd is that expiration date in the S&P 500 index. The market was at 4,900 exactly, 4,901, I think, when we looked at this trade and when we set that up. So we've gone down, we've gone away from the precipice of our butterfly. And the trade that we did was we bought the 49.80, sold the 49.90, and bought the 50.10. Okay, so let's just look at that real quick. It should be trading for actually quite a bit less than what we were able to get it on for. So we're going to scroll down to the 49.80. That's where we started, and we're going to buy that one. We're going to look at the 49.90, and we're going to sell two of those. And then we're going to go and skip the 5,000 and go to 50.10, and we're going to buy one of those. 1 by 2 by 1. And right now it's trading for a net credit of 25 cents to the account. When we did the trade, initially it was a 80-cent credit to the account. Where now we could go in and close it and pay a 25-cent debit to the account. Now, I did mention that 80 cents on a $1,000 requirement, which is the difference on the skip strike butterfly, is that you're embedding a short spread to pay for a standard butterfly, which is usually done for a net debit to the account. If you can get that credit and you just want to take it off, that's fine. Just like if you treated a short spread, if you sold a short spread, you might consider taking this trade off. You would have received more upfront in premium, and the market has gone in the correct direction for a short spread. It's gone down, which is the most beneficial movement that you could have in the index. So if it came down to around 10 cents, you buy it back and just say, okay, I made 70 cents on my trade. It was a 1 week trade, a fairly decent percentage, $70 on a $1,000 requirement, and look to do another trade at the end of the week. That's one way to approach it. At this point in time, I'd rather just let it ride because I feel comfortable about where the market is at. Now, the biggest difference is that we do have the Fed announcing at 2 o'clock today, Eastern time. And that may make you nervous, right? The VIX has definitely crept up going into the Fed meeting, and usually it does, not substantially, but it usually will drift a little bit higher going into this event. It's highly anticipated that nothing is going to happen. If something did happen and they did either decided they were going to cut by a quarter of a point or add a quarter point, obviously that would upset the marketplace. I don't anticipate that happening, but that's a risk that you have with this known news event that's happening at 2 o'clock today. All right. So you could close it out. I personally would just let it ride, and let's go and send this into the what if calculator, and we might come back and look at it if we get enough time. Why not? Let's look at it now. When I sent it there, it brought us there. So let's just take a peek at it. So you're right here. When we put this trade on, we were right up here. We were right. The 4,900 is where the market is at. We are down to 48.86 in the S&P 500 index. This is if you put it on today. So it's showing that there's a net credit of 30 cents right now, which would be the maximum you can make on the trade. Market comes up right now and it jumps all the way up to 49.90, where our short strike is at. At this point in time, we'd be down on this trade. Tonight is when first of all, the VIX will probably come off a little bit after the announcement of the Fed, which a decrease in implied volatility can help this trade out. You need time premium to wither away as the market moves this way. And eventually, what you'll see happen is that the green line, which represents prices as of today in marketing and conditions, will morph into the at expiration. So Wednesday is a huge rate of decay, Thursday even a bigger rate of decay, and then by Friday, all the time premium has to come out. And if you close anywhere near 49.90, you're going to do pretty good on this trade. You just really want to be within this range between 48.80 and 5,000. That is the TP of our butterfly, skip strike butterfly, I guess. All right, enough said on that trade. We'll probably come back on Friday. This will be an interesting one to look at, see where we're at. Not a lot of risk at this point in time. The only risk is the Fed funds meeting today. That might scare you a little bit. Okay, AMD. Our official paper trade was in AMD. We looked at a trade that I would want to do around earnings. And once again, you're just speculating on these trades. So it's not a staple of your portfolio, but you learn a lot about trading by looking at what happens with option prices. The one big known event is earnings. You know that after earnings, there's a 99% chance that implied volatility will come off. And a lot of times it'll come off very heavily. The implied volatility was over 100 in AMD. Now we see it trading at, just by looking at the February 2nd expiration, which is this Friday, now it's trading at a 50% implied volatility, which is very close to its historical volatility. The trade that we put on was 172.50 by 177.50. Now, going into the earnings on Tuesday, we looked at this on Wednesday. The market was pretty close to 175. Well, it was actually a little below that, but trading close to the 175 that we straddled where the underlying stock was at with our long call spread. The market did drift south and finished before the earnings close to the 172.50. So it did hurt our trade. We probably would have waited a little bit to put it on, but it is what it is. Sometimes it helps and sometimes it hurts. But the market now is down about 4%. It's trading at 165.92, 166. But one of the benefits of it is that they announced on Tuesday, and we did the February options. So we have Apple earnings, we have the Fed, we have Amazon, and a few more. And so with that mentioned, there's a potential for decent movement. So the chip in the chair is still there. You could potentially ride this one out. If we looked at our trade, let's remove this, and there won't be too much in it because implied volatility came off so much, but there'll be a little bit. We bought this one and we sold this one. Okay, so you could get out of it. We paid $2.20 for it. It is now trading for 60, we'll call it 60 cents. If we hit, 62 cents. That's fine. We'll call it 62 cents. We still got really tight markets. So you could salvage 62 cents you could salvage basically a third of your $2.20 that you put in on it. So you had, for every 1-by-1 long call spread that you put on, or debit spread or bull call spread, that was $220 plus any commissions or fees you might have paid. And now you could sell it and get out for $62. Not if you are, I would rather let it ride, but there's some money there. There's some potential on this trade. So you might want to salvage what you could. Now, If you did this on the open, market was, I think it was down a little bit more than 3.5%. This is an alternative trade. I don't think I would do it, but my hedge would be, and I just let you know, if you wanted to bring in a little bit of money, you won't be able to bring in 62 cents like if you sold it. But if you rolled this into a butterfly, means you would sell the 177.50. You'll sell one of those and then buy the 182.50. And then that would be a butterfly. And it shows you that very bluntly, I guess, by just looking at the trade, the spread column, the 172.50, 177.50, 182.50, all 5 points wide. And you could bring in a small credit to the account. So the trade that you would add, I'm going to remove this leg. You already have that in your account. You're only adding one of these, and you're bringing in 25 cents. And then you got potential that the market could come back and land somewhere between 172.50 and 182.50 by Friday. I don't think that credit is enough. I would probably just sell the long spread if I wanted to get out, or hope that Apple and Amazon's earnings kind of help out this market in this area, and maybe we start coming back to the 177.50 level. But this is a strategy, and I bring it up because it's something that I've talked about a lot of times, rolling in and out of butterflies, putting a butterfly on, rolling it into a short spread, could be a short put spread, short call spread, or starting with a long call spread and rolling it into a butterfly. Now, it works a little better when you have more time and it's not around an earnings report. There's just more premium that's in it, but it's a feasible trade. So you would be bringing in 25 cents. Your risk would be 100% limited to that, whatever net debit that you paid. At that point in time, 220 minus 25 would be $1.95 or $195. But then you would just let it ride and you'd see where you ended up on Friday. Did the market start drifting towards the 177.50? You need time decay to work. A lot of time decay happens on Wednesday and Thursday going into the Friday close. All right. So that would be my adjustment. If you have any questions about that adjustment or any of the other trades, please feel free to put them in the chat box. If you are on the Tradier YouTube platform, you can actually participate by putting any questions that you may have in that chat box. All right. So now we have two other big companies that are going to be announcing. And I'm pointing to them right now. We have Amazon that's going to be announcing, and we have Apple that's going to be announcing. I think we're going to look at Amazon, and we're going to, the one thing that I like about the Amazon trade here is that you have the Friday the 2nd expiration. That means they're going to announce after earnings on Thursday. Now, once again, the show tapes on live with live markets on Wednesday. So I would take the concepts and apply it a little closer to the actual earnings report, which happens on Thursday. But let's go and then let's just kind of explore what we might want to do. We have implied volatilities. Yeah, that's pretty high, 111% for Amazon. That's a good high number considering the historical volatility is around 38%. We're at 155 February 2nd. Make sure you have the right date. We got the calls on this side. We have the puts on this side. And if we look at this, one standard deviation move is right around 170 in the account. We did one of these in Netflix, and we did get the gap open more than a one standard deviation move. Also want to look at what the expected move is. So if we bought the long straddle in Amazon, it gives us a hint to what the over-under would be on the potential movement, and it's only 1 day. So the options are going to be, fairly accurate because they have 1 day to live. And this would be the move by that Friday expiration. So you're looking at about a 10% move here, or a $10.80 move. And so if you take 1080 divided by 156, we're talking about a 7% move in Amazon is what's anticipated. And that's just based off what the marketplace is, where the options are trading at on the most at the money strike for the nearest term expiration, the 155 strike. Okay. So 10 points would put it at 165. We're going to do the over because we're going to have some risk on this trade. And then we're going to look at a 5-point wide, much the same as we did in 5 points. I wonder if that's going to be enough. All right, let's take a peek at it. Let's look at it. 5 points. We got to be able to get it done for a net credit, like we did in the SPX, like we also did in Netflix when we looked at the trade. So we're going to buy this one, go up 5 points. We'll sell 2 of these, and we would skip this. Yeah, it's not going to work out. 185, and we buy that. That's a net debit of 18 cents. So if we want to do the skip strike and we want to get it done for that price, we would have to go 2.5 points, which makes our landing a lot harder. We need it to land within a certain range. So the skip strike is going to be hard to pull off 5 points wide because it's a little bit lesser stock, $156 stock, where Netflix is a $565 stock. And actually kind of interesting looking at the earnings, Netflix is the only one that's up. There's a lot of red on this board right now, but Netflix is up. I guess that's worth noting. So because we can't get the skip strike done for a net credit going 5 points wide, we can adjust it. We could go 2.5, and I'm going to show you that. Let me adjust that. And that should get her done. 150, 170 we're buying it at. We'd be selling 2 of these, skip the one, and buying the 175. And that's a net credit of 5 cents. But it's not enough of a credit for me. So if I'm looking at this trade and I want to be bullish on it, the fact that we can't go a little bit wider on the spread, on the width of our teepee, we can't go out a little bit more, we got to come in a little bit narrower, means that I'd rather just do a standard butterfly. So we remove this leg. We'll pay a small debit for this, 11 cents. And well, let's go 5 points wide. 11 cents is too cheap. Buy, sell, and buy. 1 by 2 by 1. 33 cents. So you would have $33 at risk, hoping that you get the move to the upside and it lands within this 10-point range, which we know is about a 7% range. If it can land between 170 and 180, that's where our butterfly would be at. And that's going to be our paper trade for this week. So on their Amazon's announcing Thursday after the close, if you were setting this trade up and you were doing it on a real basis, you would wait a little closer to the close on Thursday, go about 1 standard deviation out of the money, and then look at going 5 points wide and paying somewhere around 30 cents for it. 33 cents for every 1 by 2 by 1 butterfly. That's $33 that we have. But the downside is that the market does go down. You don't have you don't have the benefit of the fact that if the markets go down, you brought in a net credit to the account on the Amazon trade. Now, there's been weakness. Actually, Meta's going to be announcing earnings too. But there's been weakness in the underlying stocks. And because of this, the next stock that I'm going to look at is Apple. Apple right now is down 250, down about 1.3%. And I'm going to just talk about Apple in a different light, in that Apple is, almost everybody owns some of it in their portfolio. They might not own it in, they might not own the shares outright, but if you own any index fund, if you own almost all 401ks have some Apple under management in either mutual funds, ETFs, et cetera, et cetera. So if you are nervous about earnings, one of the trades that I would look at doing, as opposed to buying things outright here, is I would look at buying a put spread as protection. Now, if you own some of the stock, you obviously want the market to go up. If you are buying it around earnings, obviously implied volatility has been elevated. And we see that here. The February expiration, that's 63% implied. The normal is around 23%. I would probably look at doing the February 9th expiration. If you want to do it just for one day, that's fine. But this is one way where you could either think of it as I want to get bearish on Apple and I'm going to trade an out of the money long put spread to be bearish, just net bearish on the underlying. Market's not doing too well right now. So we stick with that trend. Or you can think of it as, well, I own 100 shares of Apple. How might I protect myself through this earnings report and through this earnings season? And if I'm doing it that way, I definitely want a little bit of a longer term option. I'm going to do about 9 days. I don't want to go out 3 months in time, and I never buy a protected put or something like that that goes out that far in time. Because if you're truly that bearish on Apple, you should probably just sell the stock. The longer you go out in time, if Apple continues on up, which is the best case scenario, if Apple continues on up, well, then your way out of the money, longer term long put spread doesn't help you very much, right? You would have to roll it up. So if I'm looking at protection around a position that I have in my portfolio, I'm looking to go out 10 to 20 days, somewhere within that, 1 to 2 weeks. And then it's usually around a known event, like we have earnings that are coming up right now. So 185, a lot of people say, I'll take the first 5. Apple's done very well over the last year. So I'm willing to take what deductible would you be willing to take on that underlying? And if I'm at 185, I could do the 180. So that would be 5 points divided by 185. You're looking about 2.5% before your insurance would kick in. And then when we do that, we're going to insure it from 180 all the way down to 175. We're going to add another 10 points on. And that would be right around the 1 standard deviation move, right? The delta on this should be around 16% at 175. That's true. So the delta is 15.83, showing that inside the Trade Hawk software, which is one of my favorite features of the option chains, it highlights where the 1 standard deviation move is at, which is right around this level at 175. So we'll take the first 2.5 points of risk. So let me kind of mix a metaphor. So let me reiterate. If you want to get bearish on Apple, this is a fine trade. We're going to put limited probability on it at basically $1 or $100 is all that we're willing to risk. We're going to put that trade on. You can look at it as, I just want to get bearish on Apple. I want to trade it around earnings. Or you could say, I have 100 shares of Apple in my account. How can I ensure and protect myself for this earnings report? And I don't want to spend too much for it. You're paying up for implied volatility. We're going to go out to the February 9th expiration, showing the February 9th expiration here. And if I have 100 shares, I'm going to do 1 spread. If I have 200 shares, I'm going to do 2 spreads. And they'll be 1-by-1 spreads done for a net debit to the account. So from 180 to 180 here that we're highlighting, we're paying $2 for that. That's not too bad relative considering we got earnings, but I'm not worried about Apple going all the way down to 170, 160. So you're basically looking at it as I'm going to reinsure myself. And in this instance, I'm going to sell from the 180 down to the 185. Give myself 5 points of protection, and I will sell that. And I can get this done for $1. Now, it's within a 1 standard deviation move, so I don't mind this as an outright long put spread. That's fine. And notice we are on this side of the chains now because these are the puts, these are the calls. So from 180 to 175 is what my long put spread would be. I'm going to either look at it as I own Apple in my account, and this is going to be a protective trade, or it's going to be a speculative trade to get bearish on Apple, because so far the Meg 7 stocks have been fairly weak after their earning announcements. All right. So let's look at it, and I'll just give you a read back here. This would be the official paper trade we're going to look at is Amazon, I guess, if you want to be official. They're paper trades as it is. So on Friday's show, we'll finish off our SPX trade. We'll see if we made a comeback in our AMD trade. And oh, by the way, Google and Microsoft both down. So, Google is down the most, and that actually is the stock. Seems around earnings, they just don't know what to say as a corporation. Their after earnings announcement conference call it's just Google never really gives a lot of insight on a lot of things. They're usually pretty tight-lipped about what they're doing, and that has a tendency to hurt their stock after earnings. But it's neither here nor there. Google or Alphabet has been known to also announce earnings and go up 100 points after that. So it's an interesting stock nonetheless. Microsoft down a little bit, 1.23%. That could obviously make a comeback by the end of the week. And then we also have our AMD, which is down about 3.35% or $5, which that's just a normal move in AMD. That's not that big of a move. In general, in that underlying stock, it usually trades at about a 50% implied volatility, which is where Apple is trading right around earnings at 63% implied volatility. So that's a volatile stock. So here's the read back, and we'll call it a day. Ran a little bit long here. I don't see any questions. This would be the non-official paper trade. We're buying one of the February 9th. The 9th, not the 2nd. We're not doing this Friday. We're doing next Friday. February 9th, 180 puts. At the same time, selling that same expiration, 175 put. We're doing this for a net debit of 108 to the account. That means for every 1-by-1 spread, our risk is going to be $1 or $100 plus any commissions or fees that we may pay. And that's it for this edition of Options Guide TV. Thanks for coming, everyone. Please click subscribe, ring the bell if you are on the Tradier YouTube platform. And hopefully we'll see you this Friday for the next edition of Options Guide TV. Thanks for coming, everyone.